This year to date, this is some big significant numbers, but you want to talk about Friday. There was a big deal on the market.
Yeah, Friday, so we actually went over 28,000 on the Dow for the first time ever. I think the market's flat today, so it might slightly be above or below that. So we'll see. There it is. Yeah, we're still over 28,000, up about 0.11%. That's a big deal, and let me explain why. And not only have we had a great year, up 20+% year to date, but don't forget last year during this exact same time, we were right in the middle of a correction. We actually briefly went into bear market territory, which is a 20% pullback or more. So it's been a great year, minimal volatility. It's something to celebrate, which I don't think we do often enough.
Exactly. We definitely need to celebrate the green arrows there. So what does this mean for us? What can we learn from this today?
Yeah, so I think the first thing is that market timing is not a coherent strategy. And when I say market timing, what I mean is jumping into the market, jumping out, trying to predict if it's going to go up or down. That's just not a good, successful strategy to build wealth long term, okay? So if you think you've got a crystal ball, unfortunately, I have news for you. You don't. I don't. No one does. There's too many different things to predict to be able to successfully get two things right. Because remember, you got to get two things: when to get out, but also when to get back in.
Right. And you say the jumping in and out is a volatile relationship when it comes to the stock market.
Well, absolutely. I think I probably mentioned this before, but that's more similar to gambling than actually long-term investing, because you should be thinking about retirement, kids' education, long-term goals, not jumping in and out with your most precious nest egg dollars. Right.
And I feel like when you're looking at your money in the market, you've got to go with the good and the bad. Yeah. You can't take only the good.
Well, and that kind of goes to my next point is that you have to have the right expectations, okay? So for those that may have gotten out a year ago, scared or fearful, what should they do now? Well, my advice here is that you got to get your money invested, okay? Because if it's in cash right now, it's earning very, very little. And remember that a third of your return comes from dividends. So if you're not invested, you're certainly not getting dividends. If you have a large sum of money, meaning you're about to retire, you got a severance package, to spread that risk out, meaning you don't want to invest at the highest point we've ever seen on the Dow, you could do something called dollar cost averaging, which means you put in a certain amount every month or every quarter, so you're not worried about putting it in and then it immediately going down.
Right. Okay, you always mention this too, about checking the emotions at the door, basically. So is it best to, obviously have someone manage it like yourself and look over that and sort of go, well, it's there, it's sort of out of sight, out of mind kind of a thing?
Yeah, no, I think it's probably in between. Checking it every day is going to drive you crazy, and you're going to probably lose it and then sell it. I mean, mentally. So I think the best thing to do is to check in on it every month or every quarter. Have a good strategy, be diversified, but be focused on the long term. And I've said this before, your emotion or how you react to the volatility is the biggest determining factor on how successful you're going to be in achieving your financial goals.
Yeah, you got to ride it out for sure. Okay, let's look ahead to 2020, because analysts like yourself are saying we're going to see some more gains go to that first part of the year in the market. What do we expect for the upcoming year?
Yeah, so this is the question that I'm getting a lot right now. Again, no one has a crystal ball, but look, 2020 is an election year, and all election years are more volatile than other years. So you have to have the right expectations there, especially now. It's a different time with social media. There's all sorts of stuff going on. Half the time you don't even know what to believe.
Right.
But here's my point. Focus on the fundamentals. Know there's going to probably be more volatility next year, and think long term. You can't react emotionally, especially in an election year. It's just not going to work out. And I would point back 3 years ago when the Dow was at 17 or 18,000. We had a surprise election. It's now at 28,000. If you would have reacted negatively, you would have lost a tremendous amount of gains in this past 3-year period.
Great talking points today as we get into the end of the year for sure. Trevor, thanks so much for the market update and what we can do ahead. And also to connect with Trevor, just visit shakibacapital.com.